Crude oil just did something most traders never see coming, an 8% collapse in 2 sessions, and the momentum structure says this isn't done yet. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end because I'm giving you 3 exact levels you can trade today, including a sniper setup with over 3-to-1 risk-reward. Let's get the verdict out immediately. Crude oil is trending, strongly, violently, aggressively trending lower. We are not range-bound, we are not fading, we are in full momentum flush. The single invalidation level that flips everything is $72.31. Write this number down. If we break and close above $72.31 on the 4H chart today, the entire structure resets and we are looking at a mean reversion play to $74. But until that happens, every bounce is a gift for sellers. Here's what the herd doesn't understand. Retail is trying to catch the falling knife, buying every dip because they see RSI at 26 and think oversold. But institutional money is still short, and the funding structure hasn't shown any capitulation. When the ADX is above 40, trends don't reverse because an oscillator says so. They reverse on pure price action and exhaustion. We haven't seen exhaustion yet. Now let's get technical. I want you to look at the weekly chart first. Crude oil has been in a structural downtrend since breaking below the 200-week moving average, and that level is now all the way up at $79.14. That's your master ceiling, as long as we stay below that. This is a seller's market. The weekly MACD is still accelerating lower. No divergence, no bullish crossover signal, just pure downside momentum. Zoom into the daily, and this is where it gets brutal. The MA20 is at $82.97, MA60 at $87.61, MA200 at $79.14. Price is trading nearly $13 below the 20-day moving average. That's a massive spread, and it tells you the move is extended, but extended doesn't mean over. The daily RSI is at 26.1, which is deeply oversold, but in previous strong downtrends, crude has stayed below 30 for weeks. The daily MACD is at minus 6.01, which is the most negative reading we've seen in 18 months, and here's what most traders miss, that negative momentum is still expanding, not contracting. The histogram is printing new lows, which means the acceleration is still in progress. Drop to the 4H and this is where the trade structure lives. The 4H trend is strong sell, and we have a beautiful negative momentum structure. Lower highs, lower lows, and the MACD is still negative despite a small base forming. The ADX at 46 confirms the trend is robust, and the Williams %R at minus 99.2 is max oversold. But watch the 4H CCI at minus 119. That's an extreme reading that often leads to a short-term pop. The 1H chart shows consolidation around $69.80. Sellers are taking a breather, but there's no bullish divergence on the 1H MACD, which means this consolidation is more likely a continuation pattern than a reversal based. Here's the crossover linkage that matters for crude. The dollar has been bid, and real yields have firmed up, adding pressure to commodity prices. Gold is catching a bid despite the dollar strength, which tells you there's some geopolitical uncertainty still priced in, but crude isn't benefiting because the demand narrative is crumbling. Equity markets are volatile, and the S&P 500 is sending mixed signals, but crude is leading the risk-off move, not following it. We need to watch the Nasdaq futures and the VIX structure. If the VIX spikes above 25, crude could get another shockwave lower as risk assets reprice. The bond market is pricing in cuts, but crude doesn't care about Fed cuts when the demand outlook is deteriorating. And with US oil executives signaling only slight output growth with uncertain future outlook, the supply side isn't aggressive enough to stem the collapse, but it's not a bullish catalyst either. The fundamental driver of this crash is the complete unwinding of the geopolitical premium. Remember when oil was trading at $78 because of Middle East tensions? That premium is gone, and the survey saying future outlook is uncertain only adds to the bearish sentiment. Crude oil prices are now pricing in recession fears and demand destruction, and here's the critical insight. The market is treating every piece of negative news as confirmation of the trend, and every piece of positive news is being ignored. That's how you know the trend is strong. The 1 to 2 week directional lean remains bearish as long as we stay below $72.31. But here's the invalidation. If we get a surprise OPEC Plus production cut announcement, or if geopolitical tensions flare again, this whole structure resets. The news needs to be genuinely shocking to overturn the momentum, not just a headline. Now, most people skip this section. That's exactly where the money is made. Keep watching because I'm giving you 3 strategies with exact numbers, exact stops, exact targets. Before I start, write this down. We have 3 distinct ways to trade this collapse. Strategy 1, the sniper, conservative. This is the mean reversion play that most people think is a reversal, but it's actually a precision countertrend scalp with tight risk. The trigger condition is a confirmed bounce from the 1H demand zone. We need price to test the $69 to $69.40 area and produce a bullish engulfing candle on the 1H chart with strong buying volume. The entry is on the 1H close above the engulfing candle's high. The stop loss is placed 20 cents below the low of the demand zone at $68.80. Target 1 is the 4H resistance at $72.31. That's the pivot level that acts as our profit zone. Target 2 is $74.28 if momentum carries us further. The risk-reward on this is over 3 to 1, but here's the caveat. This setup is void if we see a 4H candle close below $68.80 without the bullish signal. We need price to show us it's basing, not just falling. This trade is for the patient trader who waits for confirmation. Let me be crystal clear. This is a counter-trend play, and in a strong downtrend, counter-trend trade should be kept small. We are not trying to catch the exact bottom. We are catching the relief bounce before sellers reload. Strategy 0 sniper, conservative, entry, 69.40, 1H bullish engulfing close, stop loss, 68.80 take profit 1, 72.31 take profit 2, 74.28 risk, reward, 1:3.2 R invalidation, void if 4H candle closes below 68.80 strategy TWO, the active trader, standard. This is the momentum continuation play that aligns with the primary trend, selling bounces. The entry condition is a pullback to the 4H moving average resistance or a retest of a broken support level. We are looking for price to rally to $72.31, that's the first major resistance, and show rejection with a bearish pin bar or engulfing candle on the 4H. The entry is on the 4H close below the rejection candle's low. The stop loss is placed 40 cents above the high of the rejection candle at $72.70, which is above the pivot level, giving the trade room to breathe. Target 1 is $70, which is the round number and psychological level. Target 2 is $67.50, which is the next major structural support. Once target 1 is hit, we trail the stop to break even and let the second half run. The risk reward on this is 3 to 1 to target 1 and over 5 to 1 to target 2. This setup is void if we see a daily close above $72.31. That would signal a shift in momentum and we'd reassess. This is the primary trade for the session, selling the inevitable bounce that sellers are waiting for. Let me say this clearly, the trend is your friend, and this trade rides the trend with the path of least resistance. Strategy 2 the active trader, standard, entry, 72.20, 4H bearish rejection close, stop loss, 72.70 take profit 1, 70.00 take profit 2, 67.50 risk, reward, 1:3.0 R to TP1, 1:5.1 R to TP2 invalidation, void if daily candle closes above 72.31 strategy 3, the aggressor, high risk. This is the momentum chase for traders who can handle extreme risk. The scenario is a breakdown below the $69 support zone with force. We need price to break the 1H consolidation low of $68.90 with a strong bearish candle and high volume. The entry is on the 1H close below the breakdown candle's low. The stop loss is placed 30 cents above the previous consolidation high at $70. This gives the trade room to breathe if it's a false breakdown. Target 1 is $67, which is the next psychological level and structural support. Target 2 is $65, which is the major downside target based on the measured move from the breakdown. The risk-reward on this is over 3 to 1 to target 1, but let me be brutally honest, this trade is for those who can lose small and manage risk aggressively. If we break below $69 and the market accelerates, this trade prints fast. But if it reverses and takes out our stop, we are out with a small loss. Only take this trade if you have a small position size and you're comfortable with the possibility of a false breakdown. This is the Hail Mary of the session. It works when it works. And it fails fast when it doesn't. Strategy 3 The aggressor, high risk, entry, 68.80, 1H bearish breakdown close, stop loss, 70.00 take profit 1, 67.00 take profit 2, 65.00 risk, in reward, 1:3.0R to TP1 invalidation. Void if 1H candle closes above 69.50. Type your crude oil price target for Friday in the comments now. Let's see who's aligned with the structure. Now I want to spend a moment on what I'm seeing in the options market and institutional positioning. The crude oil options market is pricing in a 20% chance of a move to $65, and call skew is flattening because there's no panic buying. Institutional positioning shows hedge funds are still net short, but not at extremes. There's room for more selling, which tells me this downtrend hasn't reached full capitulation. But here's the thing. If we get a news catalyst like a surprise inventory draw or OPEC plus verbal intervention, the short squeeze could be violent. The data to watch tomorrow is the API inventory report. If we see a surprise draw, that could trigger a sharp bounce. But if the report shows a build, expect another leg lower. Let me give you the hidden divergence that nobody is talking about. On the 4H chart, price is making new lows, but the RSI is stabilizing. That's a sign of slowing momentum. But it's not a divergence yet because price keeps making lower lows. We need price to make a low, rally, and then make a higher low. That's the actual bullish divergence setup. Currently, we don't have that, which means the trend remains intact. The divergence is on the 1H chart, where the MACD is starting to flatten, but that's likely a consolidation before the next leg lower. Now let me break down the volume and volatility dynamics. The ATR is at 4.71, which tells us we are in an elevated volatility environment. Average daily range is nearly $5, which means position sizing has to be smaller than normal. A 1% move in crude is worth $1,000 per standard contract. Don't get caught over-leveraged. The volume has been increasing on down days and decreasing on up days, which is a classic distribution pattern. This tells me the move is being driven by real sellers, not just algorithmic liquidation. Look at the price action around the pivotal levels I've given you. $72.31 was the S1 support before it broke, and now it's a 1 resistance. That's the classic role reversal. $70.34 was S3 support, and now it's acting as resistance on the 1H. The pivot point at $73.38 is completely out of reach in the current environment, which confirms how far we've moved. The 200-day MA at $79.14 is the ultimate bull or bear line. As long as we stay below it, the structural trend is bearish. And we are not just below it, we are $10 below it, which means even a sharp rally doesn't change the macro picture. Here's the risk management pulse for this session. Never risk more than 1 to 2% per trade. No positions through high-impact news. The API inventory report could cause a $2 swing in minutes. Stops are non-negotiable. This is how you survive to trade the next big move. In a market with an ATR over $4, your stops need to be wide enough to avoid being stopped by noise but tight enough to protect capital. For the sniper trade, a 60-cent stop is appropriate. For the active trader, a 50-cent stop works. For the aggressor, a $1.20 stop is necessary because of the volatility. Adjust your position size accordingly. If your stop is wider, you take a smaller position. Let me summarize the single most critical level for the next session. Everything revolves around $72.31. If we close above it on the daily, the short-term structure changes and we target $74.28. If we stay below it, the downtrend continues and we target $67.50. That level is the dividing line between a relief rally and a continuation of the collapse. I'm watching the 4H close at 12 o'clock and 4 p.m. for confirmation. If we see a 4H close above $72.31 with strong volume, I'm looking to fade the move lower. If we see a rejection, I'm adding to the short side. Tomorrow's focus is the API inventory report and the US dollar move. If the dollar breaks higher, crude gets another push lower. If the dollar corrects, crude could catch a bid. The wildcard is OPEC plus comments. Any hint of a production cut could spark a $3 rally in minutes. But until we see that, the path of least resistance is lower. Before I close, I want to give you one more data point that I'm watching, the structure of the futures curve. The front month contract is trading at a discount to further months, which is contango. And that's a bearish structure. It tells us the market has ample supply and expects prices to stay lower in the near term. If we see the curve flatten, that would be an early sign of a bottom, but we are not there yet. The contango has actually widened during the sell-off, which is further confirmation of the bearish sentiment. If you want the full breakdown on the divergence between WTI and Brent crude, that video is live now on the channel. I'm also dropping our daily crypto and gold breakdowns today. Tap the end screen and keep the momentum going. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one. Trade smart, protect your capital, and never stop learning.